or else, and I quote, "the walls of their own edifices might come crumbling about their ears." He left them to work out the deal. In fact, he locked the door from the outside so that they couldn't leave until they had an agreement. His tactics worked. The financiers put aside their own individual interest and joined together to support the entire financial system. Thus began the restoration of confidence and the market recovery. But that episode highlighted our nation's dependence on the willingness of private interests to safeguard our financial markets. And many viewed this state of affairs as placing Main Street at the mercy of Wall Street. So our nation was ready to create a new institution to underpin its financial system. And President Woodrow Wilson signed the Federal Reserve Act into law in December of 1913. Now, the profile of the U.S. economy has changed dramatically since 1913, and so has America's financial sector. The Federal Reserve has evolved as well over the past 95 years. Although one of the key features of that original legislation has stood the test of time, and that is the decentralized structure of the Federal Reserve System. The Federal Reserve is accountable to the whole nation, not just the financial centers. That's why there's a Board of Governors in Washington, as well as 12 reserve banks throughout the country. Those reserve banks are focused on ensuring that the economic needs and interests of every region, including this one, are well represented in the policymaking process. You know, figuratively speaking, I'm your seat at that policy table. The existence of the reserve banks, branch offices, and their directors guarantees a truly nationwide Main Street perspective that influences the formulation of monetary policy. For close to a century, that structure has provided a framework for the Federal Reserve to pursue our mandate, which is price stability, keeping prices stable, and maximizing economic growth. Now, the Federal Reserve has certainly had its share of challenges since its founding, but I believe we are in the midst of one of our biggest challenges ever. Today's financial situation is historic, and many of the actions that the Federal Reserve has taken are without precedent. As we all know, global financial markets have been subjected to extreme stress for a little over a year now. We're seeing this stress play out in equity markets, where the Dow Jones has had dramatic daily swings. We're also seeing it play out in the credit markets, where they've been seized up for many months. Some borrowers simply can't get loans. So how did all of this happen? Well, it's certainly a complex story, and we don't have enough time to go through all of the details here this afternoon. But I'd like to comment on a few reasons in particular. First, and we've read all about this for many, many months now, is the housing sector. The entire housing industry boomed as a result of lax underwriting standards, soaring housing prices, and an endless supply of investors looking for attractive returns. When rising delinquency rates made it clear that hundreds of billions of dollars in mortgages were based on dubious assumptions, lenders shut off the supply of new money, people tried to sell off their questionable investments, and housing prices plunged. Second, technology and financial engineering also revolutionized the financial marketplace. Loans that were once held on the books of well-capitalized banks were now pulled together, and portions of the pools were sold off to investors as individual securities. In the cases where credit quality was low, the sponsor of the security could achieve a higher rating for them by purchasing a credit guarantee. When housing prices fell, the values of these complex securities fell as well, in some cases very steeply. In hindsight, everyone relied too heavily on models that were based on historical assumptions. Complicating matters further, loans backed by different kinds of income streams, such as student loans, the credit card loans, automobile loans, were also pooled together and securitized. When the housing industry bust, set in, investors lost confidence in all kinds of financial instruments, and they headed for the exits. Finally, many lenders were highly leveraged, meaning that they were financing many of their activities with very little of their own capital at risk. Instead, they were relying on borrowed money. Not surprisingly, the creditors who were at risk wanted their money back. And to pay for them, lenders had to sell their assets at distressed prices, meaning that they had to take huge losses. With little capital to protect themselves against these losses, people began to question the solvency of nearly all firms involved in financial markets. A recent article in the Wall Street Journal nicely illustrates how this fear manifests itself. Here's what the author wrote. Imagine that you're playing poker with 10 people, and you learn that a minority of them is broke and would not pay you if they lose. You don't know, however, who the ones are who won't pay. In this environment, the risk of losing would be too high, even if you know that most of the players are perfectly financially sound and would pay you if they lose. In this environment, any rational card player would stop making bets until the true solvency position of each player is revealed, and the bankrupt ones are expelled from the game. Having insolvent players sitting at the table spoils the game. Likewise, in today's global financial system, commercial banks, investment banks, security dealers, credit rating agencies, insurance companies, and mutual funds all deal closely with one another. So it isn't surprising that the threat that any one of them might be insolvent jeopardizes the entire system. Remember that the foundation of every financial system is confidence. In order for money to circulate through an economy in the form of credit, there must be confidence that the loans will be paid back. Similarly, there must be confidence that the infrastructure supporting the financial system will support the system in times of turmoil. Remove this confidence, and you're left with financial markets that are in a state of paralysis. Just as J.P. Morgan took bold action in 1907 to help restore confidence and stability in the financial system, so has the Federal Reserve a century later. Over the past year, the Federal Reserve has been playing a pivotal role in trying to help restore stability to financial markets. Indeed, our role of provider of liquidity and lender of last resort has never been more important. We've taken action on numerous fronts, and I'll mention a few of them. First, in response to the early turbulence in the summer of 2007, we began reducing our federal funds rate. Our efforts have been aggressive. We've lowered that rate by 425 basis points as the economic outlook has progressively weakened. But we've done more than just cut interest rates. To address the liquidity issues in the commercial banking sector, the Federal Reserve has used its traditional lending authority in creative ways. We've extended credit to banks in significant amounts for longer periods than is typical. Currently, we have roughly $500 billion in outstanding loans to commercial banks versus the $300 million we had just 1 year ago. Normally, we only lend to banks, but as the financial turmoil spread, it became clear that that lending was going to have to be broadened in scope. So in the spring of this year, we began to use our emergency powers to deal with problems at systemically important institutions, such as Bear Stearns and AIG. In addition, the Federal Reserve has been lending to a group of primary security dealers who are critically important to the functioning of credit markets. Unfortunately, the financial turmoil that we're seeing hasn't been limited to the United States. It has become a global problem, and the demand for dollar liquidity has extended well beyond our borders. Consequently, the Federal Reserve has been providing substantial amounts of dollar liquidity to other central banks. We're also paying very close attention to the performance of some particular financial instruments, such as commercial paper. Those instruments are critical to the financing daily functions of businesses, such as meeting payroll, and we've taken numerous actions to support these types of instruments.